Okay, welcome to Tax Problems and Controversies. My name is Toby Mathis, and I'm here with Eric Day. Eric?
Thank you for letting me here.
All right, and today we're going to be going over wonderful topics of what do you do when the IRS is sending you letters or auditing you or examining your return or telling you that you owe more money or that they're disallowing things. What does it all mean? How it all works? What you should be afraid of, what you shouldn't, understanding their tactics, why they are sending the letters they send, or most of the time they don't call. Do they ever call?
They'll only call if usually they've sent you a letter before.
Yeah, so beware of all those scams. We've actually had clients call up and say that an IRS agent called up asking for their social security number and birthday and all this other information.
Yeah.
That's a scam. That's not the IRS. We're joined by Eric Day. Get that off that screen. Eric Day is an attorney here at D.G. Anderson. Eric Day is, we were talking about this earlier a couple days ago, your LL.M, which means that he has a Master of Laws. He's actually a tax master, which is a degree higher than an attorney, which is a Juris Doctorate, which is a JD. So obviously he's an attorney. He's a former tax compliance auditor, which I'll let him explain with the IRS. He's a former extern with the Office of Chief Counsel for the IRS in the Small Business and Self-Employed Division in Los Angeles, California, to be specific. He also worked with the Board of Equalization in California representing taxpayers in appeals against the Franchise Tax Board. So before we go forward, let's just kind of go through what each one of those means and why that's important, especially when you're dealing with these organizations, to have somebody who actually came from the inside. So let's start right at the top with being a tax compliance auditor with the IRS. What does that mean?
A tax compliance officer there's three different ways that you could be audited throughout the system. And this is the office audit, where technically a small business, self-employed individual, someone who usually wouldn't have a whole lot of records because they would be able to bring them to the office. They bring in those records, and you conduct the audit in the office. And that's what a tax compliant officer is, just an auditor. We're different than the revenue agents. But we do the audit same as them, except it's going to be usually a smaller sample size.
Okay, so and then how would these normally be picked? Is this a random sample? Is this being drawn because something triggered it? What is the case?
Usually, generally there is some trigger points that the IRS uses to pinpoint certain individuals that might be, for lack of a better word, cheating the system, and those would go into a pool, and that pool would be, I think that pool is selected randomly, but that pool is created from some sort of system that the IRS is using, usually individuals that typically take advantage of the tax system, and they usually know where those are.
So something's bringing them into the pool, or where they do the random sampling, and then they end up on your desk. And as a compliance officer, are you you're assigned a group of taxpayers, and your job is to go out there and look at them?
Yeah, so we would get, as in the office, I would get a number of files, usually around 20 to 25 files. And those files would be my clients, and it would be my job to send out the letters to notify them that they are being audited. And then that audit, when that individual came in, they could either call and set up a new time with you, or they can show up for their audit date, and occasionally no one shows up. But when you start the audit, you would take a look at their return. We pull up their return. There's usually some sort of item checked that caused the flagging of that return. So it could be an expense, it could be certain types of income or losses that you're taking, and then that would trigger that audit, and then you would look through their return, and we were always taught if you had any irregularities that you noticed, and we always knew where to look for those irregularities, we would add those to the list, and they would be sent out with the audit on the information document request.
Okay, we'll dive into more of that stuff later when we really dive into the trigger points and then also stepping in. But were there any trends that you noticed in your office? You were dealing with small self-employed people?
Yes.
And how many of those people did you notice were actually incorporated or had actually formalized their structures?
Usually in the small business self-employed, it's people that have a Schedule C, a Schedule E, or rental property or their own business, and they usually don't operate that business through another entity or through some other.
It's the Schedule C filers.
Yeah, it's just the people that wanted to run their own business. Hairdressers, for instance, they usually don't have an LLC to cut people's hair. They don't think they need that, and so they would come in occasionally. And the reason I bring that up is my wife is a hairdresser, and it's kind of familiar to me how we would,
They're leasing a chair. They're going, I know exactly how
Yeah.
How many of the people would come in with representation with an accountant?
Very rare, especially small business self-employed section, division of the IRS. They usually are people that, heard from their employer, this is what you can deduct, this is what you can take out of your taxes. And then they would show up and they would say, my employer told us, and everyone in my business is doing this, why can't I do this? And they didn't have the knowledge from a proper tax professional, and they relied on their boss saying you can take this deduction. And
would you ever walk in and represent yourself in an audit?
Not if I didn't know. I would now, but not if I didn't know what I was doing.
Yeah, would you ever advise somebody who wasn't an accountant or a tax master, an attorney?
I guarantee you, if they come in, they're going to be back, or they're going to be asked to provide further information, because no one knows really what they're looking for.
That's interesting. Okay, and then you went and worked for Chief Counsel's office.
Yeah.
And what does that mean? You're going to tax court. You're the one that's handling the disputes that have gone beyond the audit, beyond the appeals. Now it's going to tax court. Is that where you guys come in, or is it?
Yeah. So after you're audited, if you petition to go to the tax court or appeal a decision, it's going to go to appeals either way. And so the appeals tries to settle that with you, and then as it comes up, they say we were unable to settle the account with the taxpayer. The Office of Chief Counsel, we are allowing you, or it's your turn to prepare this for trial. And what we would do is usually meet with the taxpayer and try to also make some sort of agreement with them or settle something with them before we would take it to court. And
that's an important distinction, and we're going to go over it. I know we're going to go over it the same slide. There's a big distinction. Your auditor isn't the person who's going to negotiate whether or not you owe the full bill. Their job is to do what? Just to figure out what to do.
Yeah, they know what proof they need, and they know the basics of the law and the tax code, and so they know exactly what they need you to provide to substantiate expenses. If you don't provide it, a lot of them don't even have the authority to do that, and it's
just what's the tax?
Yeah.
I don't care whether it's here or there. They're just going to say, if in doubt, they're going to disallow it, right?
Yeah, they just kind of.
How much time would they spend on these files, by the way? Like, is there a time frame, like, hey, you have to spend this much time, or you're maxed out at a max?
There's no maximum. Well, there's no minimum time frame. So there's no, you have to at least spend 5 hours. They try to get the files in within amount of 12 hours or so. They try to get them out of the office by then, because they're usually, when they conduct an audit, they're on a deadline. So it's coming up. Usually it's closer to the 3-year deadline, and then they want to get them in and out as quick as they can.
We'll go over some of those.
Yeah.
When you're talking about deadlines, you're talking about statute of limitations of how long you have to examine a return. All right. So you were with the Office of Chief Counsel, and then you went and you did kind of a fun one. You actually represented taxpayers in front of the Franchise Tax Board, appealing determinations. What was that like?
That was not as fun, because California is the worst to deal with, as they are cash poor, and so they need the money, and to be honest, they're a little bit more strict on what they're allowing to go through, and so you kind of need to know what you're going to put in a paper when you send them, or what you're going to say to them to be able to get that tax.
Do they change the rules?
Yes. Yeah. I think you can look through the history, and things have been sent to the highest courts in California and determined unconstitutional. And what they do is they'll bring it back down. They change the statute through their legislature, and
we've been telling people that for years.
Yeah, and they make it.
I talked to their counsel once, and they said, we don't have the authority not to enforce an unconstitutional law. Yeah. We have to collect the tax because they tell us to.
Yeah, and I know people that have dealt with them, that they specifically deal with state and local tax, and that's the biggest issue they have, at least in California.
Yeah, that's a huge one. We deal with it. Again, sometimes the best way is just to avoid dealing with them at all, if we can, which we try to do to the extent that's possible. And do you have a chance to win if you end up in front of that board?
It's very unlikely, I'll say that. Unless you have the people that you have to have a good position, and it's very hard to have a good position with them sometimes.
And part of tax controversies is knowing when you have a chance and with whom you have a chance. In other words, it's going to be a waste of time to fight with somebody that can't negotiate with you. It's a waste of time to fight something where you can't win.
Yeah, and it's sometimes the benefit to a professional is that they can tell you when it is to your benefit just to pay, and just you're going to waste your money if you do the other option.
Yep. No, absolutely. All right, let's jump in. Hey, where'd this slide come from? What is that guy saying? You know, you're even starting to scare me. All right.
I'm sure everyone wishes he wouldn't scare him and they'd take him out.
I may have done that. Yeah, the tax man is pretty scary, especially this day and age when they're really looking for money. So if you ask them, they're going to say yo things. So it's really important to know your stuff. And when I say know your stuff, I know a lot on the front end, but when it comes to controversies, Eric's the type of guy I would go to. I would deal with somebody that actually has experience in it, has worked in it. And so those of you who know us and have dealt with us for years, we have former IRS trial attorneys. If we're going to go to tax court, I'm going to go with somebody that's been there. You got a guy like Eric who's worked on both the compliance side and with chief counsel. You have a guy who's actually been there, done it, has contacts, I'm sure, inside the IRS, where it's a phone call instead of 4 months of laboring over arguments that are just going to get thrown back at you. It can be something that can be done a lot quicker. All right, let's talk about audit stats. Let's demystify this. One of the things about the IRS is you have to understand that the U.S. Treasury is whom we pay. The IRS is the policing force to make sure that we pay. And like any good policing force, part of it is perception. And the public perception of the IRS has to be such that there's a little bit of fear because there's so many of us compared to how many IRS agents and how many returns actually get audited. And so once you realize that, you understand why it is so, it sounds really, it's like a shark attack. We're all freaked out about going in the water, but there's like 5 shark attacks a year that result in somebody's loss of life. You're more likely to, to get killed walking home from a restaurant than you are from getting bit by a shark. Yet you're not scared walking home. You're scared swimming in the water with the shark. But the shark attacks are so severe and so dramatic, and and they're sensationalized with movies like Jaws and Sharknado or whatever it's called. That we're freaked out about it. And that's to a certain extent what the IRS does, because the stats really tell a different story. And so here we have a stat that looks like from year 2011, where we had total returns filed. And we're talking about, actually, if we go to 2013, we're talking about less than 1% are being audited.
Yeah, it's super low. And I think a percentage of that, a higher percentage of that is correspondence audits. So
explain that for us.
A correspondence audit is where you would be doing things obviously through correspondence. So
letters. They
would send you letters. And it's usually stuff that you can send documentation fairly easy through the mail to substantiate certain expenses or income. And that would be the best scenario for anybody to get a correspondence, because I think the hardest part is actually dealing with the individual. And so but if you look at that and look at the total amount that's being audited, and then a big percentage of that, the chances of you standing in front of a IRS agent or a tax compliance officer is usually, it probably goes all the way down to 0.4%,
Yeah, and I've heard that about 75% of audits are correspondence.
Yeah.
So of that 1%, you have about a 0.25% chance of actually dealing with a human being with the Internal Revenue Service.
Yeah, and it's usually easier. The kind of audits that they're doing with the correspondence audits usually are not as severe as obviously an audit that the individual would dig into your documentation and stuff like that.
Yeah, it's no fun to have them dig through. So I've actually had it where we were one of the random 50,000 companies once that had a payroll audit.
Yeah.
They were here for a week.
Oh, yeah.
They go through every piece of paper, but it's so unlikely.
Yeah.
Tell that to the guy that's going through that. Literally had white sleeves, shirt sleeves too.
Yeah.
And it had a fish handshake. It was pretty. It was comical. You couldn't have made it up. Anyway, so let's jump into some more audit stats. Oops, make sure. All right. So then we take a look at the this is kind of an odd chart. Took me a little while to get my mind around it, but the percentage of actual returns that were filed by dollar amount and the percentage of audits of them that were audited. So for example, in the first column, you have no adjusted gross income. It's that represents about 2% of all the taxpayers have no adjusted gross income. And of those returns, of all the returns that are audited, they represent about 2.6%, 2.7% of all the returns that are audited. So those are pretty much on par. Then you look at the next column. There's approximately 30, like this is scary, 40% of taxpayers filing, of that 145 million taxpayers, tax returns, 40% have less than $25,000 of adjusted gross income. That's frightening.
Yeah.
And they represent about 1% of the audits, but they represent 40% of taxpayers. So if you're making less than $25,000, you're probably never going to get audited.
Well, if you look at the number, you might think, well, no adjusted gross income is higher than someone that makes $50,000. And that's simply because there's a lot of credits in that level range that, people take advantage of. And so, I mean, they're not really beating up on the little guy, essentially.
We can see they're beating up, like we really want to talk about, they're beating up on the big guy.
Oh, yeah.
If you're making over $10 million a year, first off, congratulations.
Yeah, I know.
And second off, you've won the IRS lottery, because it looks like you're representing about 27% of those audits. That's you, but you're a really small percentage of the total returns. We're talking about 0.01 or probably less. It's probably some fractional percentage.
Yeah, and they just round it up.
Yeah. So if I'm looking at a sweet spot, and I'm kind of glancing these things over, if you're about between around the $100,000 to $200,000 range, you're about 10% of the returns filed, and you're about 0.85. You're about 1%. If you're between $500,000 and $1 million, you have a pretty strong likelihood. Once you get over the $500,000 mark, it looks like you have a very strong likelihood of being audited. Now, what we don't have broken down here are the Schedule C's. I'm going to see if we have that on a future one. Individual, there we go. So we have audit stats for, and this isn't breaking it down on the Schedule C per se, but it is individual returns that are audited. So you can kind of see the rates as compared to corporations and partnerships and S corporations. In this one, we're looking at returns filed, and this is from the IRS data books, I'm assuming.
Yeah.
Yeah,
they publish this every year.
Every year they give us these magic numbers, and they're transparent.
Yeah,
they're good about that. And so if we look at it, we can say how many returns were actually audited. Well, there was 1.4 million. Is that right? Yeah, 1.4 million individual returns audited, and compared to small corporations, which define a small corporation
is less than 500 million in assets. So
500 million or 500,000.
I think you're right, 500,000, and it's based off your assets is what it is. So.
Yep, they go off a balance sheet item, and you're talking about the audit rate's pretty much equivalent of an individual. What we don't have is, and I wish that they'd given us the data, is the Schedule C filers, because those are right around a 5% audit rate.
Yeah.
And then you kind of look at individuals. I'm not sure if we even have the stat up. No. But you can kind of see the areas that are most important for clients that are making a lot of money. When we really compare, I'll go back one slide. When you're looking at the $100,000 to $200,000 range and you're an individual, your audit rate starts to really climb. If you're making over $1 million, for example, you're talking about a pretty significant chance of being audited for those returns. Then we scroll over and we go to the next line and we start talking about corporations that are less than the $500,000 mark, and you're down in the 1% range again. Or if you're a subchapter S corporation, you're talking about significantly reducing that audit rate as well.
Yeah.
Now, granted, a lot of that income is going to end up on your individual return, but we're limiting the items that are the potential triggers, right?
Well, yeah, and it's, I mean, you think of it if you were a collector. I mean, who are you going to go after? The people that, if I make an adjustment on someone with $50,000 of income and they have one deduction that you make an adjustment, that might make $100 to the IRS, where if they're auditing these larger corporations, higher income individuals, there's more potential. It's more worth their while to go after them.
And this is one of those things when we talk about principles for doing business planning and tax planning, is it's trying to keep the money off your return, trying to get an above the line deduction. So it's not something where you're showing the income and then you have a tax credit or something on the back end, but it's something that takes your income down so you can remove yourself from the higher tax rates. If we can get money into a pension plan, a defined benefit plan, or something that is going to lower your adjusted gross income or keep it from even showing up, then those are the types of things that remove you from really being in some of those higher income brackets. Even if it's something as simple as, hey, I got $100,000 off my adjusted gross income, it may cut your chances of being audited, significantly. I don't want to say by 80%, but it is pretty high.
Yeah, I mean, no one should not want to make money.
Right.
So, I mean, if you can make money, make money. And then there's just ways, like you said, to move that AGI down so that hopefully they're not picking in there.
Okay, now we're going to get into the meat, get away from the stats and everything else. And this is where I'm really going to end up handing a lot of this off to you, Eric, is the red flags. And this has to come from experience. I'm sorry, this is not something I can talk on a lot because, frankly, my clients don't get audited. We don't get audited. Been through one. They're not fun, but I know enough from talking to ex-IRS agents and people that are with the service to know that there's always their triggers. We call them the red flags. So why don't you kind of go through the major red flags that could cause a return to get audited?
Okay, so some of these we've already talked about, and they're like the making a lot of money. It's evident that you will, as you make more money, that you will have more chance of being audited just because the benefit to the IRS is higher. So don't try to not make money, but make money and use ways. Yeah, use ways that you know that are legal to get money to where you can use it in your advantage.
Right. This is, and I don't mean to interject, this is where you use things like income shifting techniques. You have kids, or you have other organizations, retirement plans, corporations, other taxpayers, where if the money lands on, instead of you getting the money and you gifting it to your kids, for example, having your kids work and make money for your organization serves two purposes. A, they have a lower tax bracket. B, it could shave that money off of you and remove you from being a potential red flag.
Oh, yeah.
Yeah. So, all right.
Okay, and the second one, which seems pretty obvious, if you fail to report income, the IRS gets your 1099s. They get your W-2 statements. They get all the statements that you get in the mail. They're required to report it to the IRS as well. And so I think the most important one is a 1099 interest, 1099 miscellaneous, any 1099 you might receive that people forget that they're going to get in the mail. And they forget that they're going to have that sent to them. And so, some people get anxious to file their tax return because they're looking either to get a return or they just want to get it out of their hair. And so they don't remember that, I have my bank, I get interest on my savings account. And with that 1099, it just opens up your return to be looked at.
Are you at a higher risk of being audited if you file an extension, if you don't know your numbers?
No, there's no difference between an extension and filing on time, except that you get to move your filing deadline to October.
Yeah, we ran into this. This again as an aside. somebody that had an S corporation wanted to file on time, they filed on time. On their individual tax, they had more income than they anticipated. And because they filed their S corp on time, they could have done a SEP IRA and contributed to it about there was like $15,000 and lowered their individual tax. But because they filed their tax return on the business ahead of time, instead of extending it, they couldn't do it. If they had extended it, they would have been able to make that contribution right up until they filed it. So things like that, what it does is it takes away the opportunity to do some planning if you file on time. And I'm not saying don't know your tax burden on time, have everything done on time. Maybe it's not in your best interest. If there's any moving pieces out there that may possibly be adjusted, don't rush it. How about that?
Yeah, and it's all talking with your tax professionals and making sure that they know what your plan is, and then they can help you develop these strategies that you can save. The other hot points are claiming large itemized deductions, and usually this falls in the unreimbursed employee expenses, charitable contributions, medical expenses. They can usually know what your mortgage interest is, so that's not usually a huge flag or anything like that. But I think there's a consensus that, no one's going to be spending so much money for their employer that's not going to benefit them. So I think if your itemized deductions get a little high, then your chances of...
How about the phase outs? Do people usually honor the phase out, or do they try to write them all off?
I can tell you that if you don't know, most people don't know the phase out, and most people are just putting numbers into some sort of system. And I know people that file their returns by themselves. I mean, they think they can figure it out. Yeah, they think they can figure it out, and they can't. So
here's a note: itemized deductions phase out. A whole bunch of them do. So if you make decent money, you lose it.
Yeah, and just the fact that you're not taking the standard shows the IRS that they need to look at something, at least.
Yeah.
And then the rental losses are a big one, and I know that we were talking about this earlier, that they have started a program where they're going to start looking into the rental losses a little bit further, and this more has to do with people claiming the rental real estate or the real estate professional.
Yeah.
And stuff like that. And there's certain requirements you need for that. And so you need to know how you're classified, first of all, as a renter. And this can be dealt with your accountants, with your attorney. All this kind of stuff can be dealt with them, and they can let you know the requirements. And then you can either meet those requirements, or you can determine that it's a passive loss, because passive losses can only be used against passive income.
You don't lose them, you just have to carry them forward
forever. They move on to the next year. And so, but if you are a real estate professional and you can take the loss, it goes against your income. And so,
and again, it's not being afraid of the audit, it's just being able to justify and understanding what an audit is they're just checking.
Yeah, and there are things that will throw a flag that are perfectly legit and perfectly good, and
you're mentioning your church that you guys...
Yeah, and we get audited for
high contributions, high charitable donations.
I mean, does everyone, it's typical that you pay 10% of your income, and that's not...
Yeah, so if you're in a church that tithes, chances are they're going to say that's unusual, because you're going to stick out like a sore thumb to the rest of the...
Yeah, because if most people don't usually spend that kind of money, then...
Yeah, and it doesn't mean that you lose it. It just means... Just make sure you can back it up.
You got to prove it,
Yeah, and don't be afraid of it. These guys, these aren't sharks where they're just chewing you up. I mean, some of them have that mentality. Just in all policing agencies, you have those.
You get the power hungry people.
Yeah, but for the most part, they're pretty good folks, and all they're trying to do is, figure out what the tax liability. And if you have if you're cagey and you don't have backup, and you talk to them and you sound funky, they're gonna check you out. If you have an accountant. Mm-hmm. They may say, hey, let me check with my client. Well, now you're not put on the spot. Yeah,
and you don't have to explain something you may not know anything about, which could be a problem.
Yep. So again, that's not shameless pitch. That's just use a professional, because that's what they're there for. The next one.
And then just kind of to run through the last three, the meals and entertainment there's certain requirements, which is why it usually gets audited, and there has to be a purpose behind it for a business reason. And a lot of people think, well, I'm working today, I went to McDonald's for lunch, I'm going to deduct that McDonald's. And that's not how it works. And so it's a easy avenue for the IRS to get into your return. The home office deduction is another way, which I think they've revamped the whole system and they've allowed an easier process now, so that there's a little bit less substantiation required.
Used to be exclusive use, and now they're allowing,
well, and
use.
they do like $5 per square foot or something, and make it a flat fee type thing to where you don't have to prove as much. And so
don't you have to recapture that as depreciation recapture when you sell the house?
Yeah, in the new system you don't. So you don't depreciate and you don't
just
recapture.
Take a flat, but it's like a 100 foot is worth.
I think I'm pretty sure it's all covered in that $5 per square foot type fee thing. And then just like we were talking about with itemized deductions, any kind of business you have, if you have higher than average deductions in those, I mean, they know a typical business because they see a lot of returns, and they know what a typical business in real estate, in stocks, in whatever, what they're going to spend. And so what they want to do is, if there's anything that looks out of ordinary, they're going to take a look at it, and you risk being audited. But if you have those expenses, that's good. You just need to keep the documentation.
Somebody else stuck another slide in there. What is that? I'm concerned about what this effect this scandal will have on our image. Oh, goodness. Who did that? All right. Let's talk about how disputes originate.
Okay.
This is the fun stuff, guys. So if you tune in, you want controversies, let's talk about how they start. When you get those wonderful letters, what is the taxpayer? How do these things begin?
So first they'll send you a notice in the mail, and like we were talking about before, they have three basic types. One is a correspondence examination, which will basically just indicate to you that you need to send in this documentation to this address, and we'll address the problem then. Field examinations are usually going to be, they're always conducted by the revenue agents, and they are the higher net worth individuals or people that have just more business, because they're going to have more records, and they're going to actually come to you and look at your books of record, and take a look at the deductions and expenses you're taking. An office audit is the area where I've been in the IRS, where you would come to me and I would audit you there. And they all have the same, they send out a document that states you're going to be audited. They also have a information document request, which states the areas that you will be audited and what will provide for substantiation of those expenses.
All right. We actually have a question that's right on point. So one of the listeners sent in saying, I have a letter from the IRS saying that I owe monies, and I don't believe it's true, that the unreported income. So that's being triggered because the IRS probably has documentation from a third party saying that they paid you money that's not on your return.
Yeah, and that's something you can deal with all the time. It's 1099s get sent out to individuals, and sometimes the number, the social number on the return could be a number off. And it's something super simple to do. I mean, you talk to the IRS agent, you let them know what's going on, and usually it will require that you have whoever sent out the 1099 to issue a new 1099 with the correct number.
How would you typically handle that? Would I imagine you wouldn't say, hey, call up the IRS and ask them to give you docs. Would you just request your tax transcript? What would you do?
Usually what we would do is go, I would check with obviously the client calling. I would say, well, do you remember working for this person? If they don't remember that at all.
Will the IRS letter have, like, this is what you failed to report?
Yes, they will put in the IRS letter, especially if it's involving income, unreported income. They will put where the income's coming from. Sometimes it could be like today, for instance, we had a notice where someone got a notice and it was 1099B, and they didn't have the basis in the stock that was sold. And so they gave them the income for the whole entire amount.
Oh, nice.
Of the sale. And so
you just have to show your basis.
Yeah, it's really just sending in the right documentation, letting them know, hey, this is what really happened, and then changing anything that might need to be changed through the person that's issuing the 1099, or it might be something that you need to just change.
Still freaks you out, though, right? You get the letter.
Because no one wants to pay more money than they have to.
Yeah, and they're being told. And so realistically, it's A, breathe, B, either hand it off to a professional, or if it's something really simple, Like a 1099-B sounds like, hey, they reported all my income. Here's my basis and my stock.
And the worst thing you can do is not deal with it.
Yeah.
Don't let it go by the wayside. You have to take care of it, because eventually it does turn into something that's not fun to deal with.
Now, we also have somebody who's going to be this last section. He hasn't filed for a little while, and the IRS is now saying you owe all this money plus penalties.
Mm-hmm.
So I'm assuming this is the same scenario. The IRS gets information, plus they have information sharing agreements with just about every state.
Yeah.
Where they can see what you reported on your state income taxes, and they'll, for income tax purposes, and they can compare.
Mm-hmm.
But let's say that they've received some 1099s, and again, I could write up a 1099 and pretend like I paid you money.
Yeah.
Doesn't mean you owe it, but it does mean you'll probably get a letter.
Yeah.
And I probably won't get a Christmas card from it. But if you haven't filed, what does the IRS do?
They usually will send you the notice, especially if it's a business or a LLC or some sort of partnership. They'll send you the notice letting you know that you haven't filed, and they can usually find that out either from prior returns that you have filed with that. Like you said, they might file the partnership with or pay the business fees with California or whatever.
Yeah. And
so then you'll get that notice, and then that notice will let you know that you need to file. And if you don't file, there's penalties and interest associated with that. And depending on if they have income documents, there's income, and you don't get any of the benefits of the dependent deductions. You don't get any of those benefits.
They're just preparing, like in this case, it sounds like it's an individual return. They're preparing your return for you without the benefit of any deductions based off of the gross revenue that's being reported to you under your Social Security.
And they're also they also are filing this or preparing this return as if you are single or married, filing separately. Usually they're not going to give you just willy-nilly the married.
So they're hitting the bee's nest and hoping somebody buzzes out.
Yeah, taking as little off and giving you all of it.
Yeah, so that's usually. All right, let's talk about the types of notices. We're going to go through each one of these sections fairly quickly. Types of notices, you said go through it.
Okay, so the 30-day letter is usually after an audit. They have a notice of adjustment that's sent to you. The 30-day letter gives you 30 days to appeal the notice with the appeals department or provide more information. And so if you do not do that, if you decide you either forget or the audit is finalized, they'll send you a notice of deficiency, which is a 90-day letter. And that 90-day letter will allow you to petition to the tax court, and it gives you 90 days instead of 30 days to petition that to the tax court, which eventually kicks you into the appeals office anyway, because the whole point of the tax court is for you to settle. And they don't want you coming into court for every case. That would take forever. And so they want you to settle. They want you to work with their lower levels before you get up to the top, which is the chief office.
So auditor determines how much you owe. They just say, based off of what we can see, this is what you owe. They can't negotiate that. It's when you go to the Office of Appeals, or if you petition the tax court, you're going to be dealing with both the lawyers and that. And at the end of the day, those are the ones, when you see the late night TV and I settled everything's on 10 cents on the dollar, they're negotiating with you.
Yeah. They're doing all this same information.
And what's the level of experience? Like your auditor that you're dealing with, what are the chances of them being a CPA or a real tax professional?
I know when I got into the audit profession, I was just out of school. I had a finance degree. It wasn't even in accounting. It was just accounting type related, which finance, kind of goes hand in hand. And they
you could count.
Yeah, I mean, they brought me into an office and I showed them that I knew what accrual method was or cash method. And so I was hired, and then they do train, over a year's period or so. And then they're highly looked at for that year period. But then after that, you're kind of out on your own. Everything has to be approved through the manager, which usually is some sort of CPA or EA or something like that. And the low, first coming into the audit, entry level positions, which are auditors.
You want to blow them out of the water, and you're thinking this person's gonna understand and you may be talking a completely different language to them if you if you're dealing with the auditors. So sometimes you're just like, hey, you know what? We had one where the auditors they just didn't understand.
Yeah.
And when they don't understand, then they just assess.
Yeah.
And so it was a situation where it's like, yeah, we're pretty comfortable in our position. They assess. It was like a $70,000 assessment. The client's freaking out, of course. And you go to the Office of Appeals, and they go, "Oh no, we saw what you're doing."
Yeah.
You know, to get right down to I think the total assessment was it's like $2,000. There was a few technical things where the client couldn't back it up. But that was it. It was a small.
Yeah, and I mean, a lot of times they won't let something pass if they're not sure because they don't want to have to explain it to their manager.
Yeah.
Which I've seen that happen a couple times, and it's it's unfortunate for certain people. But if you have someone there that knows exactly what they can take, exactly the law of the tax code, then they can help you out a little bit better because you can explain it to them. And that.
As a professional that deals with this day in and day out, do you like dealing with auditors or with the Office of Appeals or with the attorneys?
I would say auditors are a little less likely to help you out, and they usually try to stick their ground. Hopefully you can take care of everything in an audit because that's the ideal situation, but the appeals people are more open to talking with you about the exact situation that you had to describe the expense or to describe the particular audit that you're in.
All right, now let's talk about the scary ones. Intent to levy, the final notices.
So the intent to levy notice will be sent usually 30 days before they send you the final notice. And that 30 days gives you an opportunity to appeal that as well. And there's appeal processes through the collections agency, and then you can appeal the collection process. And so they leave that open to you. If you get those final notices, the notice of intent to levy and a notice, they all provide you for the right to a hearing with the appeals division. But if you get those notices, it's important that you take care of them because you have time restrictions on those, and they will take your stuff. If you have stuff, they'll take it. And so
what's the final notice? Is that what they say? Hey, we're about to grab all your stuff?
Yeah, that's the notice where you need to either request a hearing or we're going to come get stuff.
And then the tax lien filing is against real property?
Yes, and the importance of the notice of tax lien filing is that when you owe taxes, there's a lien on all your property as soon as the assessment is made and you owe the taxes. There's something in the legal field called perfecting a lien on your property, and that gives you priority over certain other liens that might be happening, like a mortgage or something like that on your property, and it's all timing and stuff like that. And the notice of tax lien filing gives them priority, and not over anyone that's before them, but it just gives them a perfection in that lien.
They're like 6th in line or 7th in line, right? When you have the whole list of priorities, tax guys.
Yeah, well, it depends on the timing.
Yeah.
Depends on the timing of the filing. And if they don't have that perfection, they're like 8th in line if you were to.
No, it's an unsecured credit.
It's an unsecured, yeah.
Yeah. Oof. Which brings us to just a brief aside. I don't think we're going to get into this.
Yeah.
You can bankrupt away tax debts.
Yeah, and it depends. It largely depends on this and the certain year requirements with when the tax debts were assessed.
And we've had people that had no idea that you could.
Yeah,
and they'll just be buried for years trying to pay these things off, thinking the IRS can't be dealt with. Yeah, you can.
And you do need to talk to someone about that first, because there are requirements for individuals that are different from corporations, that are different from partnerships and other entities.
All right, so let's talk about this. We've already gone over this a couple times, but let's just make it as simple as possible. So you get audited. There's the audit conducted by the revenue agent or compliance officer or through correspondence, and that's where you're going back and forth. They come up with a determination, and then what happens next?
And then you either appeal. You can petition to the tax court. If you don't make that appeal within the 30 days, you can still petition it to the tax court, which will end up putting you through appeals anyway. And then what they'll do is, it's essentially 3 stages of an audit. So you get audited, then you get audited again through the appeals process, but they're a little more flexible. And then you go up to the Office of Chief Counsel. If the appeals can't decide if the appeals can't come to a decision with you, they will send you up to chief counsel who will set it up for trial. But in the meantime, they are required to try to settle with the taxpayer.
I hope that's coming through loud and clear. They're required to try and settle these. The IRS would have you believe that it's just you're just going to get ground up into muck. And there are some of those people that have had bad experiences, but it's like anything. There's the vast majority of people, all they're trying to do is resolve it. If you had a valid reason to take your deduction or to file your taxes, they're looking for substantial compliance, not 100% accuracy, substantial compliance.
Yeah.
And you're talking about real people.
Yeah, and they just, the judge doesn't want to hear every case. He wants you to work something out.
Now, when I clerked for 3 different judges, they would sometimes just stop everything and say, guys, go in the back and settle this. If you come back in here, I'm the one who asked to hear this and sit here for the next 3 days. I want to know you guys made a real try. And I remember her, like one gal, she was about 4 foot tall, just as mean as a snake. And she would point at people and say, and I think it's you that's holding up the process. And she'd point at one of the lawyers. And she goes, I'll remember that if you come back in here. And she'd kick them off. Did that type of stuff ever happen in tax court?
Yeah, they specifically ask the attorneys, what have you done to try and settle this? Have you had a conference? And occasionally the taxpayer doesn't show up through the whole process, gets in front of the tax court for their calendar call. They go out in the hall and they make a settlement, and they come back in and they say, you know what, Judge, we've settled this case. We're moving on. And so
it's fear of the unknown, right? I mean,
and they just don't realize that you're not going to jail. You're just go in and talk to somebody. And that's, it's as simple as that sometimes.
All right. So let's talk about your options in dispute resolution. Why don't you go over a few of those?
Okay.
I've heard of those before, and I'm sure a lot of people have heard of them.
So you have, obviously, if you have something that's missing on a return, there's always the option to amend the return. And that helps you out immensely because you don't have to deal with all these problems. If you just amend the return, fix all the problems before something happens. If you were to, there are occasions where people don't get a notice or they don't realize they got a notice and they miss their audit. And then they get all these penalties and fees tacked on to their tax because they weren't able to substantiate anything. That is what the audit reconsideration is. It's for you to get another chance to be audited, which sounds like a fun thing to get a second chance at, but
I want to do it again.
Yeah, I know. But you get the audit reconsideration, and that usually is prepared a certain way by us, and sometimes involves putting the tax code in there and letting them know why you deserve an audit reconsideration, and then you provide the documentation that will support it with the audit reconsideration. So it's something that needs to be prepared for you in many cases. The currently not collectible is more dealing with, certain, maybe the agent or the auditor could not find the individual or their assets. And so they'll place you on the currently not collectible status. This also goes for low income individuals who may not be able to
just go into the round file or.
Yeah, they're kind of just, I know whenever I did them with the IRS, when we did a currently not collectible, it was usually someone that, for instance, someone's husband had died and he was the breadwinner. And so
you just know you're never going to.
We just pushed it out of the system. Offering compromises are for those individuals who owe money and they're not able to pay the whole amount because of either a financial situation or things change, especially in today's economy. Things have changed a lot for a lot of individuals. And so what you do is they're looking at your net worth and what you're able to pay back through your assets and through your income, future income up to a certain amount of years. And so those are prepared usually in conjunction with some sort of letter indicating why you deserve this offer and compromise, especially if you offer something lower than what the IRS determines that you should offer. And so that, I believe, offering compromises and like audit reconsiderations should definitely be done through some sort of professional that will allow you to get the best offer you can get.
And you need an advocate who's
going
to explain it and use the language correct to give you the best chance of actually being a successful resolution. What about, and by the way, just as a complete aside, just so we're not mystic, can the IRS see what you own?
see what you
like bank accounts. Can they actually see what cars you own, what your house?
So they get 1099s, they get 1098s, they get certain documentation that shows them that you bank at a certain bank, that shows you that you do own property. And what they'll do is they can search. I mean, it's something simple that you can search online, especially here in Nevada. Nevada is one of the easier ones to find out what individuals own.
Mm-hmm.
And
real estate and things.
And
like
they
that.
can also have summon power where they can send out summons to people. And if you don't provide documentation or records that they're looking for, like bank accounts,
Mm-hmm.
they can summons your bank and have them send in the bank accounts for you.
I think you just freaked out all the Nevada clients. No, Nevada personal property. They can't see your entity, but they can see your bank accounts,
like houses is what I mean.
Yeah. If you have personally what you own.
And so they know the value of your house. In other words, so they know typically what it would cost you to pay a mortgage and to pay. And so that's another way that they figure sometimes that you aren't recording all your income, is because they notice all these expenses that you would have to take to maintain this lifestyle. And they ask you where the income's from. And that's,
can they disclose, like if you tell them, hey, I'm doing something that's unscrupulous or in the gray area. Can they disclose that to the state or anything like that? And
they usually can. It depends on if it's how serious the crime. But if you're
what if they're not doing criminal? What if you're like a professional gambler or something like that? Would they just say just pay the tax?
Yeah, they'll just they're not going to tell anyone. They're required to keep it confidential between you and them through the audit. Yeah. They have a confidential requirement, and they'll get fired if they disclose that information.
How about ex-spouses? Are they they're going to go around and say, hey, this guy's making a whole bunch of money? I'm just teasing.
Maybe if you owe them money.
Yeah. All right. Installment agreements. What's that one? That's like the final stage of, you're not going to qualify for offer and compromise. And
sometimes that could be part of the offer and compromise, is that you're willing to set up some sort of installment agreement in conjunction with lowering the total amount that you owe. A lot of times when you get audited, they will, if you can't pay the tax that day, they'll try to get you into that installment agreement and have you pay a monthly, it's essentially a loan that you took out from the government, is how they see it. It's a loan. You got money back, you owe it back. And that's
okay. Let's jump on, because I know we're getting close to hitting our max time. Statute of limitations, real quick, because there's 3 areas: assessment, collection, refund. Right? Just go over those real briefly.
So, and this is the baseline of all these. I mean, there are exceptions to the rule. When you file your tax return, they have a 3-year window in which they can make assessments to your return. And so if you file your return in 2012 for the 2011 tax year, they have till April 15, 2015 to make an assessment or to audit you. A lot of times those audits come through the end of the year 2011 or 14, sorry. And then they try to get it settled before that April 15th deadline. There are different, like I said, exceptions. They have a 6-year statute of limitations if you are misrepresenting your income and you are not putting if the amount of income that you did not state on your return is 25% of the total income.
Under reporting by 25%.
Yeah, then they move the statute up to 6 years, and then there's no statute of limitations if you don't file a return and if you are fraudulent in your filing.
Okay, that makes sense. Pretty straightforward. 3 years if you're doing things right. If you substantially omit income, it's 6 years. If you don't file or you're doing fraud, you got no statute of limitations. I'm sorry, you're cooked.
Yeah.
How about collections?
And then they have a 10-year period to collect the taxes, and that they have that up to that 10 years, which is why there's typical years. Sometimes you don't start getting certain notices, especially if you're low, you owe a little tiny amount. Sometimes you don't get those notices till it's right up to the almost 10-year period. And I mean, I'm dealing with that now. There's people that get notices and they, it's close to the 10-year period. And so they want to try and get their
money. How about
money.
those penalties and interest by that time?
Yeah.
It starts to add up.
Yeah, and the interest never stops. You got to remember that too. So
what is the interest right now?
I actually do not know. I think it's 2.5.
It's not huge.
No.
It's not huge.
I don't know exact. I think it's
Right.
2.5.
Stand limitation for refund. Oh, wow. So this is like if you're trying to get a refund.
Yeah, so if you don't file, or if you say you file April 15th, and then you determine that you want to amend your return so that you can get some of that back that you paid.
You got 3 years.
You have 3 years to do that. And if you can still amend after the 3 years, you're just not going to get back. So you can still amend your return. You're just not going to get any money back.
Yeah, they're just going to say, sorry.
Yeah.
Can you carry it forward or do anything like that, or is it just gone?
No, it's just
government wins.
Yeah.
Yeah.
You get trumped.
Get trumped. All right. So we're almost out of time. Or actually, we have 4 minutes left. So why don't I just open it up for any questions? I'm going to just check and see. You can go right on the website where you're watching this and submit a question, and we'll just answer it right live. So hang tight. See if anybody asks. So I think we've already answered a few. If and I'm just going to throw something else out there. If you are somebody that needs to talk to Eric, I know that we put up a two ways to get a hold of somebody. You can either go to our website and request a consultation and specifically ask for Eric Day. If you want to do a controversy discussion where he'll even write the letter for you, if you have correspondence or if you've received a notice or if you've had the IRS already pop up for $250, he'll go ahead and start that process and do the consultation and make sure that you're getting at least a response to the IRS issue. We try to make it pretty simple. I'm going to see if there's any other issues. What's the best way for them to start the process with you? Is it something where you need the notice?
Yeah, the best way to start one is to start to talk to me first of all, and then I need to know what the exact notice that you have is. I don't know how to deal with something until I know what the notice is, and then occasionally when I receive that notice, part of finding out further information of where I need to approach it, because sometimes the taxpayer does not know, is calling the IRS and actually discussing that with them. And that would require me having a power of attorney with you to speak with the IRS on your behalf and to be able to negotiate with them, and also just be able to access information that will help me negotiate.
Yeah, and sometimes one of the simplest things we can do, especially if there's lots of questions or if you're somebody that hasn't filed in a while, is start a power of attorney and get a tax transcript where we can see what other people have reported to you, so we know what the world is. I know we've had a few people that have come in here that have been 10 years delinquent.
Oh, yeah.
And they're freaking out, and they think that the second they start filing, they're going to jail.
Yeah.
And you go and you pull their tax transcript, and you're like, hey, you didn't have income reported for 5 of those 10 years.
Yeah.
And here's the amount, and here's the amount that you would owe. And then they usually get, it's usually what you think. It's not that bad.
Well, occasionally it's the people that start out, and so they don't realize they have to file, and then they don't.
Yep.
And
so I'm just going to leave it here. If you want a consultation with our offices, you can certainly set up for a free consultation, which will be with one of our representatives. If you need to talk to Eric and you want to retain Eric and have him handle disputes, $250 is the we'll get you the initial consultation and at least a letter off to make sure that you can stop whatever's coming at. The IRS is very active right now with their correspondence. That's one area that we've seen a lot of pickup in the last year, like significantly higher, would you say?
Yeah, I mean, I'm swamped.
Yep. So,
if that's any indication.
Yep. So start the process. Again, these things don't have to be that difficult. It's quite often, it's far worse in your mind than it is reality. And once you realize what they're asking for, you could breathe a sigh of relief. Worst case scenario is if you can't back up something, then sometimes it's a matter of, let's see whether we can still do it. Let's let them assess and go to the appeals office and discuss it with them, and see what kind of resolution can be done in your favor. If you're a fraudster, no, that's not going to happen.
Yeah.
We got to be able to back things up. Yeah. So again, sometimes it's just looking at it, and quite often, like I forget our percentages, but it's about 40% of the time when we review taxpayer returns, we find that they overpaid their taxes. And so sometimes an audit is a blessing. I've actually had them where somebody's audited and their accountant was completely goofing up their return, not in their favor. And we were able to find them substantial amounts of money. In fact, we just went through one that was a streamlined procedure. that was literally, I want to say 7. It wasn't quite 7. Probably a strong 6-figure difference as far as what was missed.
Right.
So sometimes audits are a mixed blessing. So anyway, until next time, I'm just going to say this is Toby Mathis, obviously, with Anderson Business Advisors, and Eric Day with DG Anderson. Thank you.
Yeah, thank you.
Anything else you want to throw in there before we're gone?
You just make sure you take care of that stuff. As soon as you get a notice, you need to take care of it, or else it does turn into bad.
All right. Thank you. Good night.